In this video, I'm going to break down for you the 5 most important elements of accounting. Hi, my name is The Alchemist and I'm a certified accountant. Here in this video, I'll be breaking down one of the most complicated topics that many people struggle with when it comes to understanding the accounting, what they are and how they work. This will help you understand your own finances better so we can all make more informed decisions about our business. Number 1, assets. According to the International Accounting Standards Board, asset is a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. Assets are the things owned by a company that give it value. Assets include cash in bank accounts, any physical assets like land or equipment, and some intangible assets like patents of intellectual property. The amount of money that a company has is its current assets, like how much cash it currently has in the bank. Assets are divided into 2 categories, current and long-term. Current assets include cash, accounts receivable, short-term investments like a certificate of deposit, inventory, and prepaid expenses. Long-term assets are the rest of everything else that will eventually be used up or consumed, such as land and buildings. Let's discuss specifically about what the intangible assets are. Intangible assets refer to non-physical assets that can't be touched, used, or otherwise extracted from a company's balance sheet. These intangible assets can include trademarks and patents. Goodwill is another intangible asset that applies to businesses only. This type of asset was created as a result of mergers and acquisitions when one company buys another for more than it's worth. The difference between the 2 companies' values is known as goodwill. The assumption here is that the newly combined company will have more worth than its individual parts. Goodwill isn't technically an asset, nor can it be sold for cash. Number 2, liabilities. According to the International Accounting Standards Board, a liability is a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. A liability is something that a company owes. Liabilities include accounts payable, short-term debt like a loan, long-term debt, and deferred taxes. The amount of money that the company owes to others is its current liabilities, like how much a company owes on loans it took to get started or pay bills in the short term. Long-term liabilities are items that will be paid in more than 1 year, like installments for a loan taken to purchase a building. Number 3, shareholders' equity. Company equity is the difference between assets and liabilities. The value of the company is the total amount that all shareholders own. Some companies have more coming in than they are spending, so their equity increases, like a credit card with a high balance. Companies can raise money by issuing shares of stock to investors, which means that for every 1 share they already have, the company will offer a new one. Number 4, revenues. Revenue is the amount of money that a company receives from its customers. This is simply the total amount of money that customers pay for products and services minus any discounts or returns. If sales tax is added on, it should be noted separately in the income statement as a deduction to arrive at net revenue. The total revenue for a particular accounting period is called a period's revenue recognition. But what is deferred revenue? Deferred revenue is recorded as a liability, which represents an amount owed to the customer, which may be either in cash or for the benefit of services received. Deferred revenue results from contracts requiring customers to prepay for goods and services that are delivered over a period greater than 1 year. Number 5, expenses. Expenses are your operating costs for the accounting period. These would include things like rent, utilities, and labor costs. This should be broken down into 2 categories, on costs and off costs. On costs are expenses that go to make a product, such as the cost of raw materials or parts used in manufacturing. Off costs are all other expenses like salaries, that keep the company running between sales. Operating income is calculated by subtracting operating costs from net revenue, which yields contribution margin. Are the prepaid expenses needed to be treated the same way as the normal expenses? The answer is no. A prepaid expense is recorded as an asset when payment has been made to a vendor or supplier for goods and services that have not yet been provided. Prepaid expenses are purchased in advance by businesses so they can be used before future accounting periods. These were the 5 elements of financial statements. Hope you enjoyed the video. Please subscribe to our channel and hit the bell icon for more videos like that. Tell us in the comment section about how much you liked the video and any topic that you would like to hear from us. Thank you, from The Alchemist.